You check your balance after another month of discipline. You've made your contributions, you've cut your spending, but the number on the screen looks almost identical to last month. For the beginner, the market doesn't feel like a wealth builder. It feels like a broken machine. Because your balance is small, a perfectly normal 1% dip in the S&P 500 can wipe out an entire month of your hard-earned gains in a single afternoon. This is why so many people quit. When traditional saving feels like walking up a downward escalator, the temptation to chase get-rich-quick schemes or volatile moonshots becomes almost impossible to ignore. But this sensation of running in place isn't a sign of failure. It is the mandatory starting line that every wealthy person you've ever met had to cross. Even the most successful investors in history acknowledged this grind. The late Charlie Munger famously told a young audience that building the first $100,000 is a bitch, but that finding a way to get there is an absolute necessity. It's a striking admission from a billionaire. Why would someone who managed hundreds of billions of dollars be so focused on a relatively small six-figure milestone? The answer lies in the math. There is a specific, invisible barrier built into the early stages of a portfolio that makes that first $100,000 objectively harder than the $900,000 that follows it. We are often sold on the magic of compound interest, as if it does the work for us from day one. But the mathematical reality is that for the first few years, compound interest is essentially a rounding error. This chart breaks down how that first $100,000 is actually built. On average, 86% of that money comes from your own raw deposits, the actual cash you physically moved from your paycheck into the account. That 86% represents your labor. It's the overtime, the side hustles, and the lifestyle sacrifices. You are the one doing the heavy lifting to shove that money into the bucket. Meanwhile, the market's contribution, the actual growth everyone talks about, accounts for a measly 14%. In this stage of the game, you are the engine and the fuel. The stock market is just a passenger along for the ride. The reason for this lopsided effort is simple. Compound interest is a multiplier, not a flat generator, and multipliers require a base to work with. If you have a $5,000 portfolio and the market has a fantastic year, returning 10%, you've earned $500. This scale shows why that feels so slow. That $500 in interest is easily outweighed by a single month of aggressive saving. Your labor is simply much more powerful than your interest when the balance is low. Until you build a substantial mathematical base, the multiplier has nothing to grab onto. You have to provide the momentum yourself until the math can take over. But once you cross that $100,000 line, the internal physics of your money begin to change. You've finally provided the multiplier with enough material to work with. Watch the timeline. The journey from $0 to $100,000 is a marathon, but from $100,000 to $200,000 takes roughly half the time without increasing contributions. By your third or fourth $100,000, the timeline collapses. The compounding goes exponential. The base problem is now solved. A 10% return on a $200,000 balance yields $20,000 a year. For many people, that market gain is now larger than the total amount they are physically able to save from their salary. This is the flip. Your wealth generation has officially transitioned from being driven by your labor to being driven by your capital. Beyond this point, the 86% rule reverses. Eventually, your portfolio's annual growth will outpace your manual deposits, doing more work while you sleep than you do at your desk. If you're in those early years and it feels like you're going nowhere, remember that the grind isn't a flaw in the system. It is the mandatory price of admission to ignite the math. Stop checking the daily charts for a spark that isn't coming yet. Put your head down and focus entirely on the only thing that matters right now, the volume of your deposits. Once you push that snowball to the $100,000 peak, the climb is over. From that point on, mathematical gravity does the heavy lifting for you.